Hello and welcome to Vox Markets. I am John Human and I am joined today by Steven Tredget, partner at Oakley Capital. How are you doing, Steven?
I'm good. Thank you, John, and thank you for having me on.
No problem at all. Thanks for your time. So to kick us off, I think perhaps you could introduce yourself, tell us about Oakley Capital and what you do there.
Of course. So as you say, Steven Tredget, I'm a partner at Oakley Capital, joined in 2017. In terms of the vehicles that we're discussing here, if I can summarize those. So you've got Oakley Capital, which is a private equity manager whom I work for, and they very simply put make investments or advise funds that make investments in private companies. They are typically small and medium-sized private companies, high growth, and companies throughout Europe. And then the vehicle that we're most interested in here in this discussion, I guess, ultimately is Oakley Capital Investments. That is a publicly listed vehicle. It aims to give investors of all kinds access to the private equity asset class and its performance. It's hard to do that as a private investor, investing in funds, which is why this is such a popular and worthwhile kind of vehicle, and it looks to not only, obviously, I mean, PE generally outperforms, but in doing so, it's aiming to give investors performance, kind of well above, let's say, the FTSE All-Share, a kind of benchmark of UK equities, and it does that by solely investing in the funds managed by Oakley Capital, kind of hence the name. So in stock market terms, it's known as a direct listed PE play.
Okay, and it's been really successful. The performance over the last few years has been really good, as you say. Well ahead of its benchmarks. Cheap to buy as well, which is what we want as private investors. But it's private equity has a bit of a reputation, and that perhaps discourages some private investors from actually participating. Some of these may be fair, but some of them perhaps not so fair. What do you think the sort of problem with private equity is, or the perceived problem?
What's the problem with private equity? Okay, so where do we start? Let's try and quickly knock some of these over. I mean, the first thing is to say is, when we discuss private equity, we're lumping in an incredibly wide range of investment styles into that. It's not, in terms of its scale, it's not necessarily huge, which is why there's a vast amount of growth potential for the amount of capital going into private equity. But private equity is huge, and it starts at kind of angel investing, venture capital, growth investing, impact investing, buyout funds, infrastructure funds, and so the list goes on. So I think the first thing to say is we are talking about a very big range of investments, and people have often in their minds they've got a particular view because maybe it's a view that was born by Gordon Gekko in the 80s, or by the financial crisis, or via the media, which is often telling you private equity is stealing your assets, your national assets. So let's start there. I mean, I think the first thing is that PE funds are backed by exactly the same institutions that back public equity funds. So, your pension fund, your insurance company, they are investing in, funds like Oakley Capital in the same way they might invest in, I don't know, a Schroders fund. So it's not some kind of mystical capital that, you have no exposure to, or investment. You've got similar exposures. Your pension fund is giving you that, potentially that exposure. The other thing is that the majority of private capital is there to fund growth. And so it's not that kind of vulture investing, asset stripping style of PE. It is rare. It's not the majority of investors are doing. And so to give you an example of that, let's just take the UK. Last year, there were over 1,000 companies backed in some form by private equity, and that could be anything from kind of venture capital to private equity buyout funds. 9 out of 10 of those you would consider them to be small to medium-sized companies. So these are high growth companies, where there won't be a huge amount of assets to cut. And in majority of cases, you're looking at growing the top line in order to create earnings growth. And actually, in a recent survey, privately backed businesses versus publicly backed businesses, the job creation levels in private equity backed companies was way above the public markets. And to give you that, to take that kind of step further, I'm an Oakley Capital's kind of portfolio. So if you buy OCI, you're going to look through to about 25 different companies. So I'll be talking about the average of those 25 when I give numbers. That 25 generated new roles last year of about just under 2,000. So 15% growth in employee numbers. So there's the kind of, we're not vulture funds, we're there for growth. Let's tackle the other one that's been common this year, which is Ponzi schemes. This idea that we are selling to ourselves or to other PE funds, and we're artificially stimulating or artificially inflating the value of the companies that we're buying. But first off, I mean, it's relatively rare that someone just sells, has an asset in one fund. And bear in mind, funds with a private equity, you get permanent capital, but the funds have a restricted life. They tend to last for 10 years. And you invest over 5, and then you harvest those investments over 5. And so you draw down cash as you need it, and then you return the cash as you sell assets. Just for some background. Now, what happens if you get towards the end of the life? You are going to have to sell those assets at some point. It's fine. There's plenty of time to do that. And one of the accusations comes that essentially what you're doing is you come to the asset life and you essentially raise another fund and you just sell the asset to the other fund. And you do so at ever increasing valuations. Now that in practice is not what's happening. There may be relatively rare examples of just that, where you're just kind of going into ever higher investment rounds on your own, or you're just passing from fund to fund. In the majority of cases, let's say, for example, where there is, and I use Oakley for example there, where assets have moved, where we've reinvested an asset that we've owned previously, we're doing so, one, because we know that asset incredibly well. We're deep insiders, we're on the board, we've had a huge amount of intellectual capital as well as financial capital into those businesses, and we want to continue on that journey. But if we are going to make a separate investment in another fund, typically there is a third party that is coming in and investing in, and that third party, we believe, is going to add a whole bunch of new value to that investment. And in an often case, it's a bigger sponsor that's coming in, taking a majority stake, and we are retaining a minimum stake, a minority stake. And so this isn't us inflating our own. We are selling the asset to someone else, and then looking to preserve the right or the option to invest into that. So there is arm's length transactions going on here, if that makes sense. The other thing is, if it's like, well, that's it, you're just selling to other PE funds, and other PE funds are paying more. And well, I mean, that's the same as any asset class. I mean, it's like saying the public market's a Ponzi scheme because public equity funds sell to other public funds. They are the buyers and sellers. The property market's a Ponzi scheme because you're selling to other buyers of property. I mean, that's the nature of any market. So I mean, I completely dismiss that, and I think the nature of other people in a transaction is absolutely key. Valuation risk is obviously one of the key things at the moment. Are we artificially holding our prices, values higher, and not reflecting what's happening in the public markets? So kind of where to start on that? Firstly, and fundamental to this, private equity managers are in no way incentivized by the carrying value of the companies that they own in the funds. And so to clarify that more, it matters nothing to them what price you put on a company during the time you own it. And that's because performance fees, management fees are only based upon the cash committed to a fund, so that doesn't change. Performance fees are based on realizations only. So forget what you might think of with certain funds that can make unrealized returns from the performance of those funds, like that happens in the public equity world, or may have happened with Woodford's fund, or may have happened with Chrysalis. That does not apply to private equity. We get nothing for what we may value the company at during that time. And so actually we're disincentivized, because what we want to do is when we sell an asset, we want to say we've done incredibly well and we've sold the asset at an impressive valuation. We are not going to guess now the multiple that we might sell an asset at in 2-3 years' time. There's no value in that. We'd much rather hold it at the multiple we bought it at, because that's what we know we bought. We're going to go on to how we originate, but we think we can get at really interesting valuations and those multiples we hold relatively consistent. We don't guess what the prevailing market will be in a few years' time when we're going to sell the asset, and so we remain relatively conservative. And we're not alone in the world of PE. We have no one else is incentivized to kind of hold values at artificial levels. Then the other thing is, like, compared to the public markets, are holding a wider range of assets. There's much more cyclicals in there. You've got bigger assets, kind of the FTSE 100s. They're not typical of what's backed by, particularly by listed PE. Most of listed PE is backing new economy, fast-growing businesses, where often maybe in sectors where there just isn't that much representation in the public markets. So we avoid the volatility of it. Generally speaking, these are much more resilient companies that are growing in spite of wide markets. Plus, the whole thing about PE is not just we've identified a private asset. It's the fact that we have much more control over outcomes. So we are there creating value in these businesses in spite of what's happening in the prevailing, kind of economy or markets. Our thesis is that in our case, at the very least, over a 3-year period, we will anticipate doubling the value of the assets that we own, regardless of what's happening in the wider economic environment. In fact, we model them based upon owning them through recessions in history, and we have to be able to create value in those businesses regardless of trading in those environments.
Yeah, we saw that in your recent trading update. The actual the returns coming through from this approach. The approach that the aspect of it I think really sort of sets you apart is how hands-on you are with your investments. Perhaps you can talk us through that more. In terms of creating value. As you've just alluded to, what are you doing there with your investee companies that gives you that advantage that perhaps you don't see on public markets?
Yeah, I think there's two angles there. It's what's essential is the exceptional founders that we back, and hopefully we can get on to origination a bit more. But if you look at what the first underlying part of what we do well is, you've got to back a great founder, and we are backing business. People that have founded these businesses have already had a great level of success. These are profitable businesses, and then they partner with us because they think we can contribute to that success and control the destiny. And the 4 ways in which we add value most consistently are in buy and build, so helping them, kind of particularly in fragmented markets, buy up a collection of, kind of their smaller competitors, helping them with synergies, helping them grow their products, build scale, that builds valuation in time, and for them to continue to kind of grow and dominate their particular niche that they thrive in. Digitalization is something that we're particularly well known for doing and for helping. Let's say we took a lessee, 100-year-old family-owned designer homewares kind of group, incredible legacy in doing, creating beautiful but functional products. What do they need an Oakley Capital for? Well, whilst having some great products, they had no real digital presence. They had a website, it was poor. The short version of this story is, over a 2-year ownership and creating value, we took a business, we increased its sales by 50%. We focused its product line, but more importantly, we gave them a proper e-commerce channel, and 30% of those sales are now done via the way of e-commerce. There's bringing in senior management. Often you'll find with these companies is that you have a business founder that has basically taken on every single role within the business, and they need to bring talent and expertise around them in order to grow. And then it takes us on to internationalization, helping our expertise to take them into new markets where they're previously not operated before.
No, it sounds like a very consultative strategy rather than sort of fire and forget, investment approach, which
completely.
So let's go back to the types of companies you're investing in, and the sectors that you're exposed to. So can you talk us through? I understand it's 3 areas: technology, education, and digital consumer. Can you perhaps talk us through those 3 sectors and give us some examples of the kind of companies that you're backing?
Yeah, absolutely. So taking you through those 3 again. So technology, that for us is infrastructure as a service. So let's say something like web hosting, which you can imagine that continued demand for data and data storage continues to grow, and we own one of the fastest growing businesses in Europe, Contabo, which provides exactly that. The other side of that is software as a service, and this is business service software typically. And here we've gone into markets where there isn't a leader in a particular space. There isn't a Visma as there is in the Nordics. There isn't a Sajid as there is in kind of Central Europe. And in this case, we set about building the equivalent of that in Iberia. So we acquired a platform called Econ, that became Primavera, and we created the #1 provider of business service software in Spain and Portugal. And ultimately, we merged that with Sajid only a couple of months ago. Consumer digital, you mentioned, this is kind of consumer digital platforms. So they are the likes of price comparison websites, they're property portals, they might be apps providing a solution in the virtual world, like a fitness app, or they are taking kind of great long established brands like Alessi, for example, or Globetrotter, and giving them a digital presence, running them better for kind of for the modern D2C age. And I should kind of point out with those, you might say, well, does that mean you're buying Money Supermarket? No, we're not. It's a bit like the Primavera example. We are going into markets where there has been less adoption of kind of certain trends like digital platform adoption. The easy example of that is Facile. It's the leading price comparison website in Italy. Why would you want to learn that? Are you making a bet on the Italian consumer? No, we're not. Facile is the price comparison website, is the Money Supermarket of Italy. But taking the UK, 90% of all car insurance is arranged online. In Italy, when we bought it, that 10% of car insurance was arranged online. That number's grown by nearly 70% post-COVID, but it's still only 17% of car insurance is arranged online. So you've got these great kind of repeat geographical plays where we can replicate, what's happening in mature markets in less mature ones. And then finally, education. So that started investing in premium private schools, so kindergarten to year 12, and taking your expertise there. And the founders we back there, we have rolled into, the other verticals you'd be familiar with, going through the whole gambit of education: nursery education, private school education, online higher education, after school tuition, tertiary kind of training, and then kind of business training. And I think, and the thing that kind of, why, whilst these, hopefully sound like, kind of sectors and ways to play as sectors that are interesting, the thing that essentially is key is that in most of these cases, we're backing the kind of disruptive players within these spaces, and we're riding megatrends like that continuing consumer and business shift to online or cloud solutions. I mean, it may sound like a trend that we're all familiar with now, but it still has so far to go in so many different sectors, businesses, and geographies. And then the other one is education. I mean, that rising global need for high quality, or demand for high quality and accessible education, is something that we are, kind of very keen to play. And they are trends that will persist and allow companies to grow regardless of what's happening in the broader economy.
Yeah, absolutely. I mean, these are hot sectors without a shadow of a doubt. And, you look over the last few years, there's been a lot of money chasing these kind of investments. How do you find these investments at a price that you're comfortable with the scope for growth that you're after, when there are so many other people out there who are arguably chasing the same sort of deals? Yeah,
that is a great question, and it's one that I think most defines Oakley. If I was allowed to kind of pin our success on one particular thing, clearly we invest well. Clearly we also talk about how well we create value, but your ability to source and pay appropriate prices for companies is ultimately the one thing that kind of, we've done, I think, better than all our peers up until now, and is the thing that, will keep us awake at night, because we have to continue to do it. And that is essentially this idea that we were started by a serial entrepreneur who wanted to create the kind of backer he never had. And so, we are a kind of the entrepreneur-led private equity firm for entrepreneurs. crudely. And as a result now, we've backed some, kind of 25, 30 highly successful business founders throughout Europe. And the great thing about Business Founder, if you back the right ones, is not only if they will go on and generate success, but they'll do it many times over, because they also know their industries incredibly well. They know where the hidden gems are, and in many cases, we've invested behind some of these individuals 3 or 4 times. And such is the way we work with them. We understand that entrepreneurs are not conventional individuals. This may sound obvious, but they are uncompromising, they are rule breaking, they are not conventional, and therefore you need to treat them accordingly. And that is what a lot of other, particularly bigger PE firms, don't have the capacity to do. But when that's culturally at our core, it comes, very simply for us. Such is the relationship we build with these. Not only do they continue to find opportunities for us, remember, we're not looking for hundreds of investments. We make 3 to 6 a year, and currently we're invested in 25 companies. So it's very focused, very high conviction bets that we're making. Such is our relationship with these individuals, that they then go on to invest in the funds. So of our most recent fund, which was kind of nearly 3 billion in size, 10% of that was committed by the founders we've backed. So they've had success. They've now got capital. They don't need us anymore. But such is their belief in the way we approach investing, they actually go into invest in our fund, which is a great alignment of interest. So the founder-led thing, how does that play out and why is it so good? Well, one, obviously, they're key to performance of these businesses. So they're often not looking to kind of exit their businesses. They're looking for a financial partner to help create the value we've already just discussed. That means that in 90% of the cases, we are the first time private equity investor into these companies. That's important, as I'll go on to cover. Also, because of the nature of our relationship with these individuals that could have been built up over 3, 4, possibly more years. Could happen very quickly, but often it's a trust that's built over time. 70% of our deals are proprietary, in that it's just us and them. There's not a big competitive auction. A lot of these companies aren't in a situation to do that. All this means the company, there's probably some complexity we have to get around. It's been family owned entirely. The shareholder register is probably a mess. There's probably no formal accounting. There may be very little management information systems. There is a business centralized entirely around one individual. Very few PE firms want to get their hands messy dealing with that complexity. We do. We're well equipped to. And if you can navigate that risk, you can get in it, and of course, it's less competition. So you get in at really interesting entry valuations for hidden gems. And then once we have bought those companies, we've helped them grow, we've done some of that buy and build, then these companies are exactly what the larger sponsors, the bigger PE firms, are interested in. And so, crudely, you could describe us as a firm that, kind of puts private equity into companies for the first time, helps establish them to become much larger businesses, and then essentially we sell on to the large pieces. So, we've sold recently over the last year, 1 company to KKR, 2 to CVC, 2 to EQT, 2 to Silver Lake, the big global names, which hopefully gives you some sense of the quality of the companies we're establishing.
Well, what I find interesting is, you think about sort of certainly VC or very large sort of tech investments that we've, unicorns, for example, and often they don't make money. But one of the characteristics I've noticed about your investments is that, these are profitable companies that you're backing from day one, from the moment you're investing, and continue to grow. So I noticed in the last trading update that 76% of your portfolio value increase came from EBITDA growth. This is not what people imagine private equity to be at the sort of growth end of the scale.
Sure. These are established businesses. So we're talking about, we're investing anywhere between 10 to 200 million, kind of equity checks these companies, alongside potentially, kind of our other investors. These are established, as you say, absolutely profitable businesses. The average growth of the portfolio to June was just under 20% EBITDA growth, despite either it being in a slightly slower market or off of, you imagine these businesses traded particularly well during COVID. So you're doing 20% against a very strong period. We're holding those businesses at an average EV/EBITDA multiple of about 13.5 to 14 times. I mean, if you compare that with the public markets, I mean, I don't know, I mean, what's the S&P on? 18, 19 times, NASDAQ somewhere in the 20s, and their growth rates were almost certainly, average growth rates, almost certainly lower than ours. So it goes back to your valuation point, that we've got established, fast-growing businesses that are growing in spite of the wider market. And then just to give you, while I'm on my rant, the other point is around giving that additional reassurance is that, we are selling these assets, and we've sold for this year at, our long-term average, and it was higher this year, it's about 50% premium to where we're holding them. And so these assets are in high demand, and we're selling them at multiples, arguably above, well above the public market average multiples because of the quality of these companies.
It's really interesting. I was looking at, it wasn't a fact sheet, it was one of the information providers. It's actually categorized your investment style as value, which is quite interesting because, it seems like you're growing very fast, but there is a value component to it. And actually, if you're looking at the investment company itself, you can buy those shares at a discount to assets. I mean, it's quite something. I mean, do you think that value approach is key to what you're doing?
Look, it's one part of it. I mean, we're not afraid to, where we've got information advantage, we're not afraid to pay for an asset. For example, a particularly big acquisition, it's been growing its, kind of top line 100% CAGR for the last 3 or 4 years. And we paid a market valuation for it, about 18 times. But within 1 month of owning it, because of the other deals we'd lined up alongside it, we brought the entry valuation down to 13, 14 times. So it's never as straightforward as we're a cheap buyer. There are, to buy the platform that we think we can grow something particularly special, there are market prices you may have to pay. I think, this is get in at interesting valuations because of the types of companies or the point in time in which we buy them, where we can bring our expertise to bear, but they are absolutely growth companies. We're not looking to kind of turn a company around. We're not looking to change its strategy. We've learned those lessons over the course of, 5 funds, and we're very focused now on the types of businesses that we want to own.
Absolutely, and it's great that private investors can get access to this very easily. You can buy the shares through any broker. So it really does what I think you set out to do, which is democratizing private equity.
Yeah, I mean, completely. I mean, and if you were to invest in a fund, if you were to invest in the funds, one, you'd need a minimum ticket of, kind of 10 million euros. You're committing that capital for 10 years to that fund. And at the point, you don't know what the fund's going to invest in. So there's actually, more than just a liquidity advantage with buying shares in OCI. Today we're telling you exactly what we own. We're telling you the average growth rates of those companies, and the kind of the average multiples we're holding, and the average debt. I mean, that we didn't get onto the long list of people also think that we're overusing debt, that's what's generating returns. I mean, leverage has been a relatively small component of the value that we've created. About a tenth of our returns are thanks to debt. Our average net debt to EBITDA multiple is about 3.5 times. So, I mean, in PE terms, and these are fast-growing, cash-generative, kind of businesses. So, I mean, that is relatively modest levels of debt for the kind of companies that we invest in.
And we, despite that, we're seeing very, very, very rapid NAV growth. It's working. It's working.
Yeah, and if if I had one last kind of topic on that in terms of NAV growth, I would urge any of your listeners to invest in these kind of vehicles upon NAV growth. And we've slightly touched on it,
as opposed to discounts.
Exactly. You've been touching on it. Discounts prevail. They prevail for a number of reasons, for a whole host of reasons, and we can pontificate for all the reasons they exist at the moment. Just there's been sellers. I mean, like, you've got funds that have been. We have permanent capital. One of the reasons why the liquidity of our underlying assets does not concern us is because the capital's going nowhere. We're not. It's not a situation like Woodford where you suddenly need. You've got loads of redemptions. You need to sell your assets. oh no, I can't sell my asset and I'm a forced seller, and no one wants to be a forced seller of any asset, let alone a private asset. We don't have that particular issue. But public market funds do. I mean, they're getting significant redemptions. Some of our bigger holders have seen half their funds flow out. And so they have to sell, and they flow out of medium-sized businesses first. They are forced to sell. In an environment like this, liquidity of the shares kind of lessens, conviction levels fall, and hence, our assets as a whole sector or investment trusts generally are sold down, and they do create, great opportunities. However, I repeat, performance of listed PE shares, which is the ones I know most, and I'm sure it's the case for most investment companies, are driven by the performance of the manager and the growth in asset value, which, as you've already highlighted for me, is driven by earnings growth, not us, kind of changing the multiples in which we hold the companies at. And that's what will drive shares. If you look at the 3 best performing listed PE firms last year, one was at a premium, the other was at a 10% discount, and the other was at a large discount. What was in common with them, they were both the highest generators of NAV growth. And that's why you choose that's the basis of which you choose your listed PE player. And guess what? If performance is consistent over time, those discounts will close.
Absolutely. Well, yeah, sounds like I've got a winning formula. Thank you, Steven, for talking to us today. It's been absolutely fascinating. And thank you all for listening. If you want to find out more about Oakley Capital, probably the best place to start is looking at the investment company, the listed investment company, which is Oakley Capital Investments, ticker OCI. Thanks again, Steven. Thank you all.
Thank you.